sure
roll
making
call
sure.
specialist.
Yeah. Okay, roll call, Mayor DeGoya,
Here.
Vice Mayor Lewis,
Here.
Chair Mr. Polito,
Here.
Mr. Enthoven is excused. Mr. Massey will be here. Mrs. Bamer Sandu?
Yeah, you can just call me Sandy.
Okay, sorry.
Beamer Sandy.
Thank you.
Just say Sandy.
Beamer, okay, Sandu, fine, sorry about that. Mr. Lee?
Here.
Okay.
Anybody with public comment according to the procedures? Okay, we'll move on to item 3, which is approve the draft minutes from November 20th. I didn't find anything in there that looked incorrect. Anybody got any comments? If not, I could entertain a motion to approve. Or not.
We can.
Well, it looked fine,
Make
but
a motion to approve.
There's no errors.
I didn't find anything. Second,
Second.
all in favor? Aye.
Aye.
So, we can move on to item number 4. This is the property tax presentation, and Robert, are you gonna do an intro?
Yes.
or-
Yes, sir, sure. Thank you so much, Mr. Polito. I just want to introduce, we have a presentation today with by HDL Companies. HDL does our property tax analysis, and we've engaged them in a couple of years, and again, every year we engage them to do an analysis on our current property tax year. So we have Mrs. Paula Cohn from HDL here to present the tax analysis for fiscal year 14-15. Just a quick just summary. In fiscal year 11-12, our assessed property value was $6.3 billion. In fiscal year 14-15, property value was $8.06 billion. So that's a total cumulative of 26.5% increase from fiscal year 11-12 to 14-15. Again, there are some increases due to, majority of it is residential category, which our town is mostly residential, majority, so 492 million was a result of the residential category increase. Prior property year transfer is a big component of what the 14-15 year is, and that's 228 million for the increase in our property taxes. Prop rate was 52 million, and Prop 13 netted a value change of 0.454%, and then there's a 207 million increase in other changes in the positive changes category, which means there's upgrades to homes, to properties. So without further ado, I'd like to turn it over to Ms. Cohn, who's here to present what happened, what transpired in the 14-15 year.
Mr. Massey.
Yeah, it's coming up. Sorry about that.
You can put a gold star next to Mr. Massey's name now, too.
You guys tending my house for termites.
They were tenting your house?
Yeah, I was waiting for them to show up.
Oh my goodness, blame it on them. You might wanna come over here and sit so you can, oh,
You gotta put 2 sides in
They
it.
have it. This is
You
advanced.
authorized it.
I did, but I never looked that way.
I want to thank you for inviting me to your beautiful city again this year. You've got the books. I'm going to do a little bit on trend analysis and then get a couple of the high points of the books. The book is 14-15. You're halfway down the road 14-15 with regards to your revenue receipts. I've also done some analysis looking forward to 15-16. I think I need to start off by saying we've had 3 really good years. You had 2 years where you grew 9% between tax years. This year you grew more than 6.5% between tax years. A lot of that has to do with the Prop 8 reductions that the assessor made between 2008 and 2011-12. He started restoring those values in 12-13, 13-14, 14-15. They're almost all gone. And that, for you, has been responsible for about 3 to 4% of your growth every year. Once that washes through, we'll be looking at the CPI, and for 15-16, it's 1.998, about as close to 2% max as you can get without getting 2%. We we also, we're looking at properties that sell, and when they sell here, you get a big bang for the buck. And then for any new construction, and we're seeing a lot of vacant property. Two pieces of vacant property alone were purchased for an increase of $29 million between tax years, and that's before they even added a structure up there. So, you know, what we're seeing is that when properties turn over, some of them have been held since 1980, 1985, and when they turn over, we're seeing a tenfold increase in the value due to that sale. That's sort of unprecedented. It's kind of fun to come to the Silicon Valley area because I see that here. I don't see that anywhere else in the state, with the exception of maybe Santa Monica and some of the hill, you know, Palos Verdes estates. But other than that, everybody else, this is an aberration in their life.
So it's not, the increase isn't just because I became city manager?
No, well, I will give you credit because I would be a fool not to.
Better be good than lucky. Better be lucky than good.
All right,
Yeah.
how do I get this thing move forward? Because that's not working. Sure. There we go. So in the book, the first page that, you don't need to go back to the book, I'm just going to show you here, is a 5-year history of the values in the town of Atherton. And as I pointed out verbally a few minutes ago, and I'm going to walk over here because some of you can see this, in 2012-13, you had a 9% increase, last year a 9%, this year 6.5. You have outpaced the county of San Mateo every year. I don't care if you even go back and look at the prior year when you had a negative 3.1%, the county only grew 1.1. So you're outpacing the county, and you're in part the reason that the county's doing so well, because what's going on here, what I'm seeing in San Mateo is the growth that we're seeing. And I commented that after 15-16 next year, we're going to get back to those good old days where we can expect to see the CPI, Prop 8s are going to be done, what got built and what got sold in town. So if we see a year where you only see 4 or 5% after 15-16, that is normal. You probably could go back to somewhere in 2000, 2001, before we started our trek up to that bubble and then down off of that bubble, when that was more normal. And you're pretty built out. So what we're seeing is properties that are selling for a whole lot more and properties that are getting demoed and rebuilt.
That's a good question.
Sure.
You mentioned San Mateo County. How do we look compared to like Hillsborough, Woodside?
It's so nice to have you in the room.
A lot of people would say that.
Yeah. No, come down. Keep going down. There's a report that shows that. I'll jump to it at this point. Okay. Since you asked, and show a slideshow. There's one on the bottom toolbar.
You could have 5 from.
Right there. Yeah. So if I look at the value change in every city in the county, and this is by percent change, not by value change. The largest value change was in San Mateo, and then after that we've got South San Francisco, we've got Menlo Park, we've got Burlingame, and you're right there, 4th or 5th from the bottom, or from the top in terms of dollar change. Percent change, no city in the county grew less than 3.7%. If I went back and looked at San Carlos last year, San Carlos had a big bump last year. They sort of came out of the recession a little earlier than some of the other cities, so they got the benefit last year, and you're seeing it continue. You got a good benefit of that last year too. But as we're looking now, in San Mateo County, there's probably less than 15 or 20% of those pool of properties to be restored left, and when they're gone until the next recession. And we can talk about that if you want to later, because there will be another one. Okay, let me go back to slide 3. Here. What we've done, and this is also in the book, and Robert alluded to it, is look at the total value change between tax years. And in the town of Atherton, all properties, you grew $492.6 million. The growth that is attributable to the residential component, and you do have some other uses, but residential obviously is the big element here, It grew 456.8 million, so 92.7% of all the growth we saw between 13-14 and 14-15 had to do with something in the residential marketplace. Those vacant properties that I mentioned, two of those properties, as I commented, were responsible for a $29.7 million increase. And it's a piece of property that had a house on it. My house had been owned since the 80s, and they go in and they demo that property, and the assessor says, what are you building? Oh, the mega mansion's coming in. The vacant land is obviously worth more than what you paid for it, or maybe close to what you paid for it. Next slide. So, to summarize, of that 6.5% overall growth that we saw, 92% came from the residential uses, and about 6% came from the vacant property that we saw grow. Next. And Prop 8s are something that we've been tracking, and if you look closely at that report in your portfolio, each of these years is independent. Every year the assessor would add new properties that he thought should be reduced. Some got sold, so they fell out of the pool that were potentially available for recapturing. So every year that number moved, kind of jockeyed around. Your peak year of Prop 8s was 2011, and you might recall that we had a federal stimulus program in 2010, but after that washed through, we got hammered again in 2011 when property values declined slightly again. What the assessor did in 2011 is he had reduced the values to 9.3% of all the single-family homes in town had seen a reduction in value. By the time we got to 2013, last year, only 128 of those properties still remained in that depressed pool of value waiting for recapturing. And if the economy were to turn around immediately and the assessor were to have reinstated everybody, we would have been looking at the potential recapture in that buff color, $131 million, could potentially have been recaptured. Of course, the economy didn't do that. It's coming back in fits and starts. But that was the potential out there. When we received the 14-15 roll and could then go back and compare that data against what we'd seen in the prior year, we saw that of those 128 pieces of single-family properties, 89 of them, all but, 40, received an upward increase in their value. And of that 128 total, 45 have been fully restored. So clearly half of those that saw an upward change in value last year are right back to where they would have been had they never have seen the reduction in the first place. The amount that was restored, the $51.5 million, that's about 39% of the pool that we talked about, of that $131 million. And when we got to 2014 and could still see the properties that had not been reinstated or recaptured yet, we still had about 98 homes out there that are awaiting recapturing. Every year we see somewhere between 10 and 15 of those homes sell. When they sell, they reset, so that kind of bleeds away the potential. Yes, they're selling for a whole lot more, so I wouldn't worry about that too much. But at any rate, we still were hoping to see 98 properties, and the amount that's still pending recapture is a little more than almost $95 million. When we put our modeling together for 15-16, conservatively, we said we're going to expect half of that to get back on the roll with these restorations for 15-16. A few of those will sell in calendar year 15, and the balance will come on in 16, but it's going to be a lot lower. And maybe we see 30 million. Yes?
Maybe I'm misunderstanding, but recapture potential is what they can increase the tax on a property because they decreased it due to the recession.
Correct.
Why is there so many properties that it hasn't been, there's been no restoration?
Because your properties are unique. I can't look, or they can't look, at a housing development that all went in 2004 and 5, and they all sold for $560,000 to $590,000. So when a couple of them today start selling for more, they can apply that percentage increase across the board. In your community, they have to go out and find a comparable home. Sometimes that's easily done, sometimes it's not. And so they have to wait until others sell in the neighborhood to come up with a comparable. So it's taking a little longer to get those bigger values back on the roll. Yeah. It's just.
Is that a staffing issue?
I don't think so. I think it's a data issue. How many, 12,000, 15,000 square foot homes that were built
this particular point in time that have these amenities, are there in the same area of the town of Atherton? That's what they're having to look at. Typically, they are restored by neighborhood. So as I mentioned, in some communities where you did a condo complex in 2004, you've got the neighborhood there. You can go and say, oh, now they're going for $80,000 more. That's a 20% increase. We're going to increase all of these 20% next year. So they'll come. And I suspect, as I've commented, that you've got maybe 2 years, one good year and one not as good year of these restorations of other done.
I have one quick question on the vacant land. You said there was 2 properties that were vacant land, but when you're headed to construction, don't you go back in and say, my structure is gone.
Right.
The value should be assessed at the land only value. And doesn't that stay there until occupancy?
No.
Is that what's incorporated in?
No, what happens is, well, there's 2 things. Some of these were vacant to start with. And if there are plans for that vacant land, it's worth more than if it's just sitting there and nobody's gonna do anything with it.
So your vacant land value
Right.
incorporates a structure not yet built?
Correct.
Or
Plans submitted, and it's not my number, the county numbers, but once the plans get submitted, the assessor then looks at that value of the land and that value will get increased. It will get increased another time when the structure is finally in place. Because when they go out and value this $5.7 million structure, they have to divide the property values between the land and improvements. It may tend to pull the land value down and improvements up, or vice versa.
So it's a book value versus an actual value?
Absolutely.
Okay, so they're projecting what the future value may
Could be. Right.
Okay.
And of course,
Isn't
that person,
isn't
the
that
person
good?
that's doing that from the building permit is probably not the person that goes out in the field after that certificate of occupancy is granted and they go out and see, okay, what kind of amenities, we have granite here, do we have tile, what do we got going on here? And start looking at what's this value of this property really, how should it be gauged?
Which is probably going to be a lower number than actual.
Often, and if it isn't, they will file an appeal typically, whether or not, and again, it's harder to get an appeal approved here because you don't have a comparable. Yeah.
Okay.
And they can turn and say, well, the assessor's got all the data. Well, these 3 properties have same square footage and they sold for a lot more than that. So no, we're not going to use that. Let me mention one other thing before we go one other step down the road. Robert mentioned that your value this year is $8,068,000,000. That's big, right? 1% of that number is $80.6 million. So for every $80.6 million added to your bottom line, you see a 1% increase in revenue. Okay? I'm going to mention that because we have some empirical data that I can tell you what properties are selling for in town, how many of them sold, and what that amount added to the bottom line is going to be next year. That's a given. The assessor's going to enroll the value paid in the sale as the market value next year. So we can already quantify that, and that helps us get on the way to what are we looking at the 15, 16 mil. Now that I said that. We looked at this, we can go beyond this. One of the reports that's in your portfolio looks at the top 40 deviations, positive and negative. We've had no negative in the top 40, they were all positive. And the interesting thing is that of these, none of them grew less than $3.1 million. The guy at the top of the list, residential property at 85 Isabella Avenue, the year-to-year change is $18.5 million of that piece of property. Yeah, shake your head, right? What? The one below that, on Faxon Road, added a new structure. It was previously vacant. That one actually added a new structure, and now it increased $18.4 million. It was valued at $400,000 last year. The added structure, we pick up $18.4 million of pre-taxes. So anyway, anything that's got a 0, 0, as you see, number 3, current value is $27 million. The next one is $30,300,000. Anything that ends in a 0, 0 is probably a sale transaction, and you can see that on the detailed report that follows it. Because when you buy a piece of property in a sale, you typically agree on a 0, 0 value. You don't deal with dollars and cents. You deal with a standard price. So as you go down that list and you see those zeros are 0, 0 on the end, you can pretty much count that those sold last year, and they sold for a whole lot more than the prior year. all properties that have been held since the mid-eighties. Some of them have probably been held since the late seventies, but not a lot of those still exist. You know, a lot of folks these days, when they take their property, they put it in a trust. And that trust often passes to the family members without going to probate, depending on the value of the property, they may not hear. And because of that, we see a lot of properties that don't get revalued when they pass from dad to son after dad dies and mom has died years ago. So that sort of transfers to the heir apparent. And the owner may hold on to that property, or they may be cash poor and decide to sell it. And if they sell it, we see it come back on the roll with a new value. If they don't sell it, it stays at that pre-Prop 13 level for a lot longer. And in most cities, there's still 10 to 15% of the homes in town have not sold since 1978.
So you're saying that if Prop 13 property is in a trust and goes to an heir,
Mm-hmm.
it does not get a step up in basis?
It does not. It goes from parent to child, grandparent to grandchild. You can do both of
God,
those.
my kids are gonna love.
Aren't they gonna love you? Now, the thing is, there's a limit, I believe, to what we can pass on and not have a good, and I think it's like 7.5 million per heir, per decedent. So it'll be 15 million total. Some of the homes here may be worth more than that, so there will be some probate or
Seems like, cause I
capital
was
gains
trying
costs.
to think it was a step up in basis gross.
no.
That's
No.
interesting.
The vacant transactions we talked about, and of the top 40 value changes, they were all positive. Next. Yeah. This is a view of the median sale prices. When I came out last year, and I probably didn't have quite all of the 2013 sales, we were right close to that tipping point to seeing that current median price as to what it had been at the peak of the bubble. We've exceeded that. In 2008, that's when you had the largest both median and average prices reported before this, the last 2 years. In 2008, the median price was $3,975,000. This year, it's $4,518,750. So you have completely exceeded that. In fact, right now, looking at the sales, properties are selling in Atherton 13.28% higher than what they sold for last year. Last year, they sold for 4.42% more than the prior year. If you look up the 4 prior years, we're looking at somewhere in excess of 40% increase in median sale prices over the past 4 years. That is the biggest ammo that I think the assessor has for pulling his trigger and reinstating just about everything that reinstated, because the median prices are certainly bearing that out. Of course, the median price in some areas may not be what's received in another area, and has to look at that. Next.
So this page is newer than the.
Yeah, I think the book probably went through October. The dates are at the very top of the report, so I think I got an extra month on
Yeah.
the date.
This went through August
Through August,
31st.
so that's why.
And so you've got through November,
Uh-huh. So what was it in August?
10-8.
10-8, yeah.
Okay, so it's continued to go up, percentage point a month almost. 10%, so that's good. All right, I talked about that 8 million, of the 8 billion, you need 80 million to move up 1%. And this report looks at sales transactions again through the end of November. And we had 109 homes sell in 2014 calendar year. The value on the roll before those sales was $382.3 million, and they sold for $664.4 for a 73.8% increase when they're selling. In each of the past 5 years, only 1 year did you exceed that, and that was in 2012. That's when we came out of the bubble and things started going good again. But that $282 million is the equivalent of 3.5% added to your bottom line. So if we get the 2%, 1.998%, we add this 3.5%, we're now at 5.49% without looking at any new construction and any Prop 8s being added. As the very last report that, I'm not sure if it's the next report or right a little farther than that. When I get the last report, I'll show you what the computer says you're going to see next year. I'm holding right now at 5.49 because I don't know what the assessor's going to do with Prop 8s. And I can schedule half of them, I can schedule all of them. If I schedule half of them, you're coming up to 6%. You had 6.5 this year, you're probably gonna see close to what you had this year again next year. Yeah, if you've got one-time projects, this is what you should be looking at, because, it's going to slow down, and the sustainable projects are gonna be the harder thing to come up with later. Next. All right, a lot of words here, but, looking towards 2015-16, there are things that we know and things that we don't know. What we know is the CPI that was reported, at the end of December, so that's the 1.998. We know that you've got a 3.5% increase due to sales transactions. You have another month to go. That may go up a little bit higher as we get through the end of December. I've got sales through the 15th of December, so I'm only missing 2 weeks at this point. So again, we're looking at 5.49%. What we don't know are how many of those homes are going to be restored. And with about 80 million left, and I took off some because some properties have sold this year. And if I apply half of that, 40 million, that's going to get you to 5.99, 6% around numbers for next year. Next. And this is what the computer says. The computer, wish I could.
Is this in our book?
The first bold
What's
black
in this
number
one?
is your total value of real property. From, and to that we apply the CPI, it's gonna add 150 million, that's roughly 2%.
Can't read
We're
that.
then going to do a transfer of ownership, the 2.82 million that we talked about. It doesn't like the TV. And then, we look at, an amount that the computer says will be restored, which is 58.6 million. I put in 40, so it's a little more generous with what it thinks is going to happen based on, the modeling that we do. The personal property on both the secured and the unsecured are also going to be flat, so at the end of the day, we're looking at 6.08% here, slightly more than mine. 6% is a good number, and we may see more than that for next year, 15-16. I do wanna do one thing. In the book. One of the comparisons to the other cities in the county, and this one is alphabetical, thank you. So this looks at what the number of properties that sold in 2013, this is in the book, and the
Do you know
number of
what
properties that sold in 2014. Again, this is not a full year yet. This also goes back to August.
Page 20.
It does show the median price last year, median price this year, and then percent change. And again, this goes back to August, but it's August for every city. And you'll see that your median change year to year back in August was 10.8%. And the city with the highest median change is Palo Alto. Believe me, they fell the farthest. They have the farthest to come back, and they can see, it doesn't take that much to pull them up.
Right.
But you see their median price is 490,000, 1/10 the median price here.
Right. Woodside.
Yeah.
They have a
Next
couple good
page.
properties.
So let me get to the revenue report, I think is on.
And then Colma is coming on strong. There's a neighborhood called the Garden.
There we go.
Oklahoma needs to come in.
Yeah.
Turnover in plots.
That turn out plots, yeah.
Yeah.
We're gonna do some double deckers.
Page 25 in your, in the book that we put together shows the revenue that we're projecting for 14-15.
Okay.
You're a Teeter City, you're not, you have the license, right? Yeah.
The county gets them. We're not
Okay.
here.
Okay. So, we're estimating 6,722,000 and change as your revenue for 14-15. And then we projected the revenue on the other page for next year. As a reminder, the weighted average of all of the tax rate areas in town generates a little more than 8 cents of the property tax dollar for the town of Atherton. Big whoop, right? Some of the cities around you get as much as 25%. Yeah.
So what is this net, what percentage do we receive from the total that's collected?
Oh, the total,
Is there a
net
percentage on that?
collected,
Wait a minute, shall I look at this?
Yeah.
That's
That
median
includes
change.
ERAS.
yeah, median change.
No, that's wrong. Oh, I'm looking at the wrong one, what
Page
page?
24.
I was looking
I
at
think
page
this is it,
25.
representative general levy estimate.
Yeah, that shows everyone's share of
That includes E-ref.
the county
Okay.
of, without
All right.
E-ref.
I- It's on the wrong page,
It's pretty
To the
interesting.
tax elevation.
yeah,
One more.
yeah,
Yeah, pretty cool. This report, which is also in your book, shows that you see
Look at
roughly
the-
10 cents, I think, on that report. Of your 10 cents, you're left with 8.57, and the county ERAF shifts off with 1.987 cents.
Yeah.
We have, the fire district in Menlo Park also has a shift, as does the county of San Mateo. That's money that's going, initially it was going to ERAF to pay for schools. But in 2004, with the governor's swap of revenues, the triple flip and the VLF and lieu, it now comes out of that pot to pay for your VLF and lieu. So you put it in with everybody else, and it comes back out of the bottom line, back to you. That's in many ways protected by Prop 1A, although the state can borrow, as they have in the past, from that account, as long as they pay it back with interest over a certain period of time and not more than a certain number of times in 10 years. So, if they ever get into dire straits again, know that pool is not sacrosanct. They can come back and take it from you again.
Paula,
Yeah,
the general levy estimate share, the 10%,
yeah.
and some other communities get 33%, et cetera. The rationale or the reason that is
When
because,
Prop 13 was adopted, what it required was that the share of the 1% would be based on the revenue that was collected in the 3 years prior to the adoption of Prop 13. So if a school district got 25% of all revenue collected in those 3 years, it got 25% of the 1%. So any city that had a huge capital improvement plan, that they had jacked up their mill rate, that's how we did it before then, to be able to subsidize those particular improvements, ended up being rewarded for doing that, because they ended up getting a disproportionately high share of the 1%. And it's memorialized.
and also some communities may have fire responsibilities or full service communities.
True.
Whose rates
Which
are
raise
higher.
it up, yeah. So, in a city that might incorporate now, typically gets a smaller share because everybody's got a smaller share to give, but if they also take over a fire department, that boosts up their money a little bit. Of course, a lot of it goes to fire, it's a big expenditure.
Sorry, I have to ask,
Oh.
where is the tax for Foster City going from? Why is it 0? Just curious.
Yeah, Foster City, put itself in a redevelopment project area, for the most part.
But they don't get any tax.
And now redevelopment's been axed. What they also get though is tax equity allocation, a TEA. So they get money from the county sort of under the table outside of this scheme that was set up back in 1978. So be careful what you wish for. You get a lot of money when you were in redevelopment, but once that goes away, it's there's a lot of grief going on right now with that.
So
Yeah, go ahead.
through the chair.
Elizabeth's always first.
Well, not always, but the county library,
Yes.
.0344, is that, if I go back historically, is that always that
It's
number?
always that.
That number,
Yeah, let me explain. I talked about this,
last time,
this scheme going back 3 years and coming up with a number.
okay,
Every year, this is how the system works. The county looks at every tax rate area. If the values go up, we get more revenue. If the values go down, they get less revenue in that tax rate area. They sum them all up. They divide the library share by the county total, and they get a factor, and the county library gets that share of every tax dollar collected. Whether it's collected in your jurisdiction or somebody else's, that's how the money gets back to you. Because when Prop 13 was adopted, we didn't have computers, we were working on yellow pads. And the easiest way to get the money back to you was to develop a fraction system, so every dollar that came in got fractionized back out to everybody else.
so is that the same number that, all the other cities have? The
No,
point
it's gonna be different in every
03?
jurisdiction. It's different in every single tax rate area. This tax rate area is the single largest by value in town. If I go and
The
print
Selby
out
Lane area over
Yeah.
there, that's a different number.
different number, and it could have a different share, it could have a different school
Lindenwood has a
district.
different number.
Yeah, you may have
a library
Different
district in
district.
one tax rate and not, you may have a different school district in various tax rate areas. So all of those pieces,
How many different tax rate areas do we have here in Atherton?
I would have to go back and look.
Well, we know we have 3 elementary schools,
Yeah, it's
so
on-
those are 3 separate tax
The-
rate
No,
areas.
it's
Well,
more than
look,
that.
no, but you look.
This is Menlo.
Yeah, and then
But we-
there's Sequoia, and then
No,
there's,
but no, but
and Las Lomitas.
we have Los Alamitos, we have
Well,
Redwood City,
Redwood-
and we have Menlo.
Well,
So
Redwood
those-
City is Sequoia.
No, Redwood City
You
Elementary.
have 32 tax rate areas in town,
32.
32.
Wow.
City of Santa Clarita's got 400.
32 different tax rate areas.
That's interesting.
32
Jim,
tax rate
did you
areas that
know
have
that?
got,
Mr. Winston, did you know
Taxable value.
32 different tax rate areas? I mean, I never knew that.
I knew there were 3 school districts.
If you would like,
Yeah.
we can print out each tax rate area and show you what share of the tax dollar goes to every taxing entity within each of those tax rates. That's
So
Press-
the tax rate area is not a taxing entity.
no, that's a tax rate area. The tax rate area consists of the taxing entities, the fire district, the school districts within them.
Understand,
Yeah.
but each district would have a little different spread here in this
Absolutely.
tower.
Yeah.
I think that we should see those.
I
Yes,
would
you
love
Yeah.
to
Okay.
see that.
No kidding.
If
That's
it's
the
just a press of a button.
Never heard of it.
Oh my gosh. How much fun do you have?
Oh, I have a lot of fun, but I put people to sleep because I have so
32.
much fun. Nobody likes to talk about what I do.
Well, I still have a kind of
Yes.
a more basic question. Does East Palo Alto do to collect 33 cents when we collect a dime?
They don't do any more than you do today. They did something different than you did back in 1978. When this was
What'd they do
established.
that was so smart? I know
Well,
that
they
many smart
probably
people
had
in there.
some infrastructure, maybe some street widening or so they jacked up for a year or 2 or 3 what they billed everybody. Back then, they said, okay, we need $6 million this year, and this is our value. We divide the $6 million by this value,
So this is this 3-year period.
and that
you're
comes up with
talking
a mill rate. So now we charge everybody this rate on their value.
about. And it
So-
never gets redone?
And back then, it might not have, it might have gone up some years and gone down some years. I think
Well,
that's why Prop 13 came
Prop 13
along.
froze it. What Malcolm Dudley told me was that if we had invested $1 million in the channel just before this was set,
Mhm.
and if we had done it during the period, it would have significantly
Increased
changed
your amount.
the 8.5-cent rate that we have now.
Prop 13 rewarded the
missed that
guilty
by a
unless it
year.
was completed.
Penalize those that didn't do anything.
It penalized you, yeah. There were some cities that, I worked for the city of Lawndale in Southern California, we did not have a property tax. So every year they'd balance a budget, they'd say, we balance a budget without a property tax. Well, you're still collecting 1%. It's just not coming to you. It's going to the county and it's going to the schools because the tax in California is 1% of the value. So we were just screwing ourselves by not having a property tax. After the fact, obviously, and you could never get it approved after the fact without going back to the voters, so can't do it. You can do it, but it doesn't happen often. Paramedic taxes sometimes.
So the 3 cents that goes to the library out of our
Mhm.
column.
Huge $8 billion
Stack.
valuation.
What determines, does that go clear back to Proposition 13
It
too?
does.
How much goes to libraries?
Yes,
Mhm.
everybody
So
should.
the only way that what it at least appears to me from my own little myopic view of our financials is that absurd sums are going into
Mhm.
libraries way beyond the value that they bring to the people.
Yes.
So what needs to be done to,
Unfortunately, cities ask me this all along, how can we increase our 8 cents? Well, you have to get somebody to give it up. And schools are forbidden to give up any of their share, because if they do, then the state has to backfill more with ADA. The state doesn't want any part of that. So now you go to the county, you go to flood control, you go to Vector, you go to those kinds of people, and nobody.
yeah, but those are all,
They're all set.
nobody can stand up and say, I want some money from schools, and these other things you're talking about, services. I'm very specific about the library. The library seems to have money coming out its ears that could be better spent most people would think, in some other ways. So how does that, what action needs to be taken? I presume
what
it's a statewide action.
Oh, well, probably, but, you know, you'll find that in some jurisdictions, the library shares a penny. Yours is 3 cents. So
And
they're,
so they want to.
so they want more
We don't
money.
care about that.
I shouldn't say that.
We care about us.
So anyway, what I'm saying is legislation that might help you might harm somebody
What's it?
else.
But these numbers still go back to when Prop 13
Yeah.
was enacted.
Right.
So all this, anything that I don't like, I can blame it on Prop 13,
Yeah.
including my low
Yeah.
property tax.
Unless it's
Yeah,
brought
so be careful what you are, griping
No
about.
wonder nobody's messing with it.
That's right.
Yeah.
Does anyone broaden the definition of a library?
That's
That's what we're
that is
doing.
the core issue.
That's what you have to
That
do.
is the
Yeah,
core
yeah,
issue.
yeah.
So just to deal with the
Yeah.
library, I met with Jerry Hill to try to explore this possibility
Mhm.
because there's excess library taxes out of Atherton. We know that, right? We're
But
accumulating
not so
a
much
surplus.
excess library taxes out of Pacifica
No,
or
no,
out
but
of
well,
East
but
Palo
out of
I mean,
Atherton
in
there
the
are.
county, in
And
Cherry Hills,
so-
the county.
And there's an action that could be taken at the state level. But what he told me was that what would happen is exactly what is being discussed with respect to Sequoia Hospital, where there's still a hospital district, even though that hospital got sold, and there's now a board that's redistributing those funds that come into the hospital district to other, county or public nonprofit purposes. He said what would happen if we were to reduce the library rate, which is conceivable at a state level, that money would go to all of the other, into the county, and be redistributed where all the other monies go into the county. So you couldn't have it redirected, for example, to the town. The town would get an incremental benefit, but so would every other
You would
taxing
probably
district
get 8% of
that our dollar would go to. So the real answer is not to change that, but it's to change what the definition of library services are. That's exactly right.
Exactly, because then you're,
To make it beneficial to
Well,
the taxpayers.
For example, free internet to all or something along those lines.
Exactly, free internet to all.
Yeah,
The
yeah,
21st
yeah.
century
No,
library
I
is
think
an
they've been
information
reading his
management
blog,
hub, so it should be free
Right.
internet. That's
he sends out.
in the form of a fiber
iPads to
network
everybody,
to every residence.
loading of.
Anyway, different discussion,
Yeah.
Education.
but a
Electronic
relevant
webs,
one.
Yeah. So anyway,
Any other questions? I'm done with my presentation.
Anybody?
Thank you for your time.
Thank you very much. I don't know how many of these you do, but you're
I got 58.
you're
of the
very.
90.
It's always a pleasure to have somebody that knows what they're talking
I
about.
appreciate
That's
that.
the truth.
absolutely.
Just want to remind you again, the vice mayor, right?
Yes.
Vice Mayor Lewis asked to see the 32
Yes.
different taxes.
Yeah, yeah. I will print that out and send, I'll send it to both of you tonight.
That's astonishing.
Paul,
Yeah.
when you do that, can you also, I don't know if you have one on the map.
Unfortunately, this is what you have to understand, is tax rate areas, homes next door to each other can be in different tax rate areas. So the
Yeah.
maps make absolutely no sense. They jump all over streets, they're all over the community.
But will it indicate what area it is?
No,
So we won't.
you have to look at the address.
The address. Oh, we can
Yeah,
look at
with that. I mean,
addresses
I can give you a list of
Yeah.
town with all the
Yeah.
tax rate areas and you can see where's what.
and the addresses.
Yeah,
Would it have the addresses?
I have the addresses, yes.
Yeah.
So that's
There's
why-
only 2,500.
So with 32 tax rate areas, it's not geographically based.
Correct.
It's a whole variety of
It's
parameters.
based on who was getting what services back in the 1976, 77, and 78. From what taxing agency.
Generally, it should be
It should be
geographic.
sort of,
Yeah.
but you might have a lighting district that was in place back in 78 that's no longer here, or you have new areas that were not part of that lighting district, they're in different tax rate area. So,
32.
So we will
Okay.
use this information.
Paul, appreciate it.
Yes.
you've got my number, anytime, call me,
Okay.
if you have any questions.
Thank you
Thank you
so
very
much.
Thank you.
Appreciate it.
Have a good rest of the week.
and the updated ones, I guess. The updated information, do you have the updated information?
No, but
Would you
I'll
like
get
me
it.
to,
Please.
we sent the addendum book out in March, so we'll
Okay.
have everything through the end of December now.
Oh,
And
Thank
we
you.
can
okay.
share.
Oh, okay.
We will do, thank you so much.
Oh, they'll do an updated
Good.
through the full year.
Yeah, because what's in our book is only through August,
I got that, and what was on our slides are only through November.
November, yeah. And I can't read these.
Unless anybody has an objection, we'll move on to item 5, which is to review the last year's fiscal year in financial statements. I'm sure nobody has any questions.
Except for you?
I've got a few, but
No.
some of you may remember one of my questions last year or the year before had to do with why they said there were 14 funds and I could only find 13. And George even went along with me. He says, well, we ought to change that to 13. So 14 appeared again. But Robert found the 14th fund. It's the tennis fund.
Right,
And it's
yes.
buried in
And
the
it's
general
rolled up with
fund.
the general fund.
Just roll up
In the general
it's
fund.
all one.
So
Yes.
why it's a fund at all, in and of itself, I'm not sure, but
Good
I'm
question.
sure we have bigger fish to
Right,
fry.
that's why.
I can explain that, because there had been in times gone by, certain council members very focused on making sure that
Tennis got its money.
tennis, well, either could be proven to be a drag on the town and we should get rid of the courts altogether.
Either got its money or didn't get other
Right,
money.
right. It only got and paid for its money, and if it made money, then it could support its maintenance and stuff like that. Or if it didn't get its money, then well, the town's not gonna, support the handful of
So
people.
is that person gone now?
Yeah,
So why wouldn't it just be pushed in with
Part
all
into
the
the
rest
park?
of the park? Yeah.
yeah.
And
I mean, it's pretty silly to
Mhm.
have a tennis
Right.
The issue though with the funds that have been allocated
for the keys or something.
tennis facility had been diverted to the general fund at one point in time when Galuzzi was here.
Yeah.
The maintenance money that's been provided,
Right.
maintenance of the courts was being diverted to the general fund. And then when maintenance needed to come forward, it was always a big
They said, well, we don't have
jumping
any
up
money.
and down.
There's
for
no
the
money.
for that.
Because
Well,
we spent it from the general fund.
Right.
I don't
That's
think
the
we
same
should
thing that
spend
was
much.
happening in
So
the
I don't
building
know if that's
department
part
too.
of it. Yeah,
Right.
yeah, yeah.
So
no, and
I don't
we
wanna
can,
spend a lot of time on it. I just
Right.
think it's stupid.
right,
So if you
We
wanna
can
make that
approach
fund
that.
go away, it might be a good idea.
right. And to do that, we'll have to bring it back to the council. Because if there any funds that are created, it's through the council that they get created. They have to give the
So
okay
they
to do that.
uncreated.
Mm-hmm.
That's a
So
good
we'll,
idea.
so to do away with it, we can approach them, and then within this, as we approach the new budget year, to do that adjustment, and then just roll the tennis fund within the park fund or within the general fund,
Okay.
because right now it's only $17,000 is what makes up the tennis.
It just pales in comparison to so many
Right.
other things.
Well, I have a question though, Bob. So are those funds, are they listed under note B, or, under note 7,
You
item
won't
B,
find,
called
you,
fund?
there's no way from reading this,
Well,
you'll find that 14th fund.
No, if you, this is my question, if you look on page 50, it looks like 14 funds that are under restricted
Right.
and assigned to.
Right.
Yes.
It comes out to 14, and the tree committee, for example, is less, there's some
The
others
tree
that are less
committee
than the 10.
is not considered an actual fund, so it's not part, you won't
It's not,
see
so
the tree
these
committee.
aren't exactly the funds. Where are the funds listed?
They're in the supplemental page, they're
back.
starting on page 63, and
Okay,
going back,
okay.
there's all the roll-ups for the different funds.
I see, okay.
And
But-
tennis won't be there.
Okay.
Right, because we rolled it up into the general fund, but if like you mentioned on page 50, on note 7, if you see assigned to, there's the fund
I
balance.
saw that,
You see the tennis program, it's 17,640.
I saw that.
That's what the tennis fund balance
That's
is,
what I was looking at.
and so that's what's rolled up into the general fund. Yes, ma'am.
I have a question on page 51.
Mm-hmm.
actual annual operating expenditures. So, this number, can you give me this number somewhere?
Yeah, so what was,
What is your actual annual operating expenditures?
well, the actual was 12 million. And if we look at page 18, sorry, page 22,
Page 22.
the actual expenditures was 11.7 million. On page 22, sorry. And the 20% was saying that at no point in time could the unassigned balance be below, less than that. And right now it's
Way
over
over.
that. It's by like 86% that it's over. If we look at on the financial highlights on page 3, so there's a financial highlight component, and in the top of page 3 it says management discussion and analysis. So the fourth bullet point says at the end of the current fiscal year, the unassigned fund balance for the general fund was 8.2 million, or 69.9% of the total general fund expenditures. The town adopted a fund balance policy of not dropping the unassigned fund balance below 20% or the annual actual expenditures. So we're definitely meeting that policy. The total fund balance at the end of the fiscal year for the general fund was 10.4 million. And of that amount, if you look at, of that amount, the balance is, of the 10.4 total million, fund balance, 8.2 million is the unassigned balance.
So in your staff report,
Mm-hmm.
right, you say the unassigned fund balance is 8.2
Yes,
with a total fund balance of 10.4.
yes,
Okay, so we're in sync with the
Yeah.
20%
Mhm.
there.
yes ma'am.
Comfortable.
And then also,
Good.
we're in sync, yes. And this is, the unassigned fund balance is what we've done the reserve policy on, in the past, what we've discussed. The 15%, we're meeting that, it's 1.7 million, is that 15% contingency. And then, so you add that, the 8.2 million for the unassigned balance, and then there's a assigned balance of 434,000 on, that equals the 10.4 million.
Okay.
So on page 6,
Yes, sir.
it's kind of a town of Atherton net position, government activities, kind of comparison between 13 and 14.
Yes.
Where some things got kind of grouped together there. The non-current liabilities of 245,000. Several other places in here it shows we have no long-term liabilities. Non-current liabilities. So what is that $245,770? Because I can't find it.
Okay. $245, that is,
I mean, if you look at page 10, it shows their outstanding debt
Yeah.
is 0.
that's the long-term, the 245,770 non-current liabilities, that's the long-term, compensated absences within the town.
Okay,
So that's what that means, that's what that 245,770 is.
so it's time off we owe people.
Yes, sir. And that's, meaning it's non-current, meaning that it's not within this 1 year, so it's in
Yeah, I
future
get it.
years.
I got it,
Yes,
I
sir.
got it. So that doesn't mean I can find it. Okay.
And you can find that if you wanna see it, if you look at page 15, the statement of net position kinda breaks down the total, that's townwide, net position, assets,
Well, I think,
liabilities, yeah,
I saw, I did find it there, I've got it
Okay.
marked,
okay,
but I don't know where it is. And I couldn't figure out why we would have any long-term liability. I mean,
Right,
we
right.
could have some lease obligations or
Right.
something, but I couldn't find them.
Yeah.
we don't.
And so the one that's due in less than 1 year is also compensated absences. So it says note 1G. So in the footnotes, it'll show.
Oh, okay, I see now,
Yeah.
those are, I didn't realize that those was indented and fell under comp.
Yeah.
That's my
So
fault.
it's page 39. If you go to page 39, it'll show the breakdown of the compensated absences.
I like the paper you printed it on. Nice.
Expensive.
That's because we're trying to get rid of it. I'm sorry. It's because it's paper that we've had for a long time, so we're using it. But we decided to
Thank
use it
you.
for committee packages. And
So on,
stuff,
on page 7, some categories are kind of regrouped, kind of, I don't know, I'll say somewhat arbitrarily. I can't get those numbers to line up with the real numbers. For example, if you go to page 25,
Mm-hmm.
and you look at, start looking at expenditures,
Right.
and the numbers don't match.
Right. You must have a wrong page than I do. I'm just kidding.
What page?
It's the correct page,
Seven?
and good question. And the reason why, Mr. Polito, is because on page 25, that's the general fund only. This page 7 is the town of Atherton's total net position.
Any money moving in or out of any fund?
Of every funds, yes. And good question, because you're comparing, you're trying to compare it to find it, but that you're looking at the revenues for the general fund. And this page, on page 7, the town's change of net position is the total governmental funds of the town. That's every fund and every internal service fund as well. So that's what that means.
Okay, I want to check one thing. Well, they still don't exactly add up.
Right. The revenues, because the general fund, when we do the net
Well, no,
position.
Not
no,
revenues.
It's not just that, if you take,
From the
it's
expenditure.
very hard to read because you got it on, it should have been landscape mode, but I did a half-assed job of copying it so I could read it. And if I look at the, for example, total revenues for all government funds, I get 16,852, and on this page is 16,878, et cetera. I mean, it's the same for general government spending, or no matter what category I look at, police, none of the numbers jive.
Okay. So you get 16. Okay, so you have to take the total governmental funds, which is page 23, 22 and 23, and you add those.
Oh, wait a minute.
You gotta
I'm
include
looking
the
at-
internal service fund as well.
Oh, I was looking at 25 and 23. Hold on.
Internal service funds, if I, which are not on the spreadsheet on pages 23 and 23 to 25, I guess they are.
What page does 23 continue from? Is that a continuation from 22?
No, it starts on page 22 is a statement of revenues and expenditures.
Right.
And it carries through to 23, so.
Right, that's what it does.
So, if you take, I don't care which category you take, if you take police, it shows a number that's different than the number on that summary sheet on page 7. I'm just trying to figure out why they're different.
I'm almost all off, but
Okay. If you look at page, okay, we wanna compare page 7, look at page 16. And you'll be able to kind of put in, you'll get the total general fund revenues, that 13,686 that you're looking for, not the total general fund revenues, but you'll get the total general revenues.
On page 16, general revenues, 13 revenues. Yeah,
Okay, so see charges for services, and if you look down, charges for services,
I don't know what page you're on.
page 16.
2.39.
Got it.
Yeah, see that 2,393,945?
Mhm.
Okay, if we go to page 7, there's that 2,393,945.
Charges for services, okay,
Mhm.
we've got that.
And then the operating grants and contributions, it's 797,531. And if you look under program revenues, there's operating grants and contributions, 797,531.
mm-hmm,
Then if you go to taxes, general revenues, taxes, it's 13,209,504.
yep,
So then you see there's underneath that, those program revenues, it says general revenues in the middle page.
yep,
And then it has a category, taxes. Then there's property taxes, sales taxes, other taxes. So you see property taxes were 11.5 million. Sales taxes were 156,000. Other taxes were 1,536,128 for a total of 13.209,504. So if you compare that, go to page 7, taxes is 13,209,504.
I see that, I can get it to jive with page 16.
Yeah. Well, the reason why the net position is taking the townwide funds, and you're combining them all to get the whole townwide net position. So it's taking all taxes, like the taxes where it says property taxes, that's property taxes, that includes, that's general fund, that's the channel district, that's the library, that's the parcel tax. So
Tell me what
total
chart-
taxes is
tell-
11.5 million.
Yep, I'm seeing that relationship, I just wasn't seeing it with the
Yeah.
spreadsheets back further, and I still
Right.
don't, so I have a question. This charges for services,
Mm-hmm.
that's what we charge for
Right.
building fees or whatever,
Mm-hmm.
and et cetera, et cetera, et cetera.
The statement of activities, what it does is it takes, okay, what is your operations and what is it that you charge for within your operations? So the way these statements work is they want to see what you're charging for whatever you provide in service. So once you do that, you get to a net amount, and then you add in all your taxes that you receive from the county, from the government agencies. So once your program revenues or whatever you charge to provide a service, once those are counted, then you take into consideration revenues that are from from taxes, sales tax, other taxes like franchise fees, document transfer tax, business licenses. So then you add those in, and then you get the net effect, which is our change in net position was 4.6 million. Meaning we were in the positive as a total, as a town, as a whole. All the charges for services, all that we provided from the town, all our what we've charged and what we get in property taxes and all other taxes is enough. It netted a positive 4.6 million.
I still don't, I guess, understand, I can get these pages to jive, I see that. So now, when I go back to the fund summary spreadsheets that start on page 22, I think it is.
Mm-hmm. Yeah, the way the statements start off, it starts off as a group combined, and then as you get further in the statements, then it breaks it down to individual. Then you get to the general fund, and then you can see what the general fund did, what the parcel tax did, and then it breaks them down individually. But right now, when you see them at the beginning, it's all rolled up as one entity.
But let's just take back in pages in the 20s.
Okay.
If it says police expenditures out of the general fund were $5,112,000.
Right.
This page 7 says police expenditures were $4,029,000. As does page 16.
Right.
Now, explain to me the difference between those two numbers, and I'll work out the rest myself.
Okay.
That's $1 million.
Parcel tax,
Is that what it is?
I would assume a component of that's parcel tax, it would be in the rolled up statement, but not
Mhm.
within the general
Yeah.
fund expenditure.
The 5,112,000 is what is the general fund component, just the PD portion. What you see over here in page 7 is the roll up of everything within up to the all different components. And the thing that you have to understand, there's the internal service fund. So we have eliminating entries. Okay, and the internal service fund has the biggest thing. It has the equipment replacement fund. It has the employee fund. It has the liability fund. It has the workman's compensation fund. So all those things have to be eliminated and charged to different departments. And so that's what we roll up. That's what we do within the audit, because the auditors have to say it's what they call it. If you ever heard, it's called GASB 34. GASB 34 says you have to roll up all your different entities, and you have to charge and account for all those internal services that you charge within your departments. You can't double count them. So yes, you see the 5.1 million in PD, and then when you look at page 7, you're all like, but it's 4.1 million. Well, we have to back out the charges for the equipment replacement fund. We have an allocation that we do that, so it eliminates those, and that's where you get that total number of 4 million. But individually, as a general fund for the PD, you're focused on the 5.1 million. That's the expenditure, right? Those costs. What you see up front is the eliminating entries. That's rolling everything, and because you can't double count it, so that's why you get as a net it's 4 million for the PD. Would you see on page 7 for police services?
I'm getting it now.
I have a question. The reduction in revenue from other revenues
Mhm.
between 2013 and 14 is principally from the Facebook
Yes, sir.
revenue from 2015, is that correct?
Yes, sir.
350, yeah. And the, whatever it is, $800 and some odd $1,000 general government increase?
Where are you?
I'm looking at the net position information.
Okay,
It's
page 7, okay.
Yeah, it's sufficiently summarized that it's easier to digest. So those are just the two things that sort of jumped out at me. I could explain everything else. I get the Facebook and the government expense increase. That is principally what? That's not building, or does that
The general
number
government
include building?
increase includes the city manager's office, its attorney, finance, and non-governmental. So there is an increase, 3.4 million to 2.5 million, and the biggest component in there is we allocated 2 million towards OPEB trust.
Right.
That was paid out of the non-governmental fund department. So that's why there's a bigger increase from one year to the next, because we made that big contribution. So if you take that 2 million out, it would be less. If you
We
take
did
it,
2 million versus 1.2 million. Is that the comparison?
1.25 something.
Yeah.
$2 million allocation.
So it's the difference in the payment to OPEB that accounts for the difference in that number.
yeah.
Okay. that
And
makes
if,
sense.
and if you look at page 8 under general fund, under page 8, there's some descriptions and kind of some bullet points that I put in of what kind of led to some increases. And so the second bullet point says there was a 1,292,000 increase in general fund operating expenditures.
Right.
However, this is due to the 2 million contribution towards the OPEB trust. So it's considered, it's rolled up into the general government component. Any department that you see that is not listed separately, like public works is separate, police, building, planning, all the other departments are rolled up into general government. So that's attorney, city council, admin, non-departmental. They're rolled up into this general government department.
I see.
So on page 15,
Mhm.
we show a net OPEB asset, which is
Yes.
money we've put into this trust fund.
Mhm.
When are we gonna have to start showing all these offsetting liabilities for pension, and will that begin in?
That will be coming down. We're in the process of this, within the next fiscal year of having to start showing those amounts. The
Sure.
GASB, this one for the OPEB is probably 2 years out and actually having to show that liability. But right now, we've made major headway in paying off that OPEB. So we're about like 2.5 million as a liability. But right now, we're just
So we
required.
won't have an offsetting liability shown for some period, for
Right.
some number of years.
Correct.
But the pension stuff starts next fiscal year, allegedly, right?
Yes, but the only way it's going to start is we're waiting for CalPERS to do their component, and that's going to take. It's supposed to take effect this year, but CalPERS needs to come up with what they have in their point in time, and once they do that, then the cities can, because it has to come from CalPERS. The number has to come from CalPERS, and then the cities do their portion. So that it's supposed to take effect this coming fiscal year, new fiscal year. So we're still trying to figure out if we're gonna get those in time. So we'll keep the council and the finance committee.
Okay. On page 18, deposits payable of $1,000,003.
Mm-hmm.
Is that all construction related deposits?
About 900,000 is building deposits. Of that, about 700,000 is forfeited, meaning the city it's the city's revenue, because we have a.
I mean, 400,000 plus 900,000.
No, the 400,000. We have planning deposits. We have public works deposits. We also have other deposits that also include.
Recycling.
Yeah, we have the surcharge. We have technology surcharge, and that's rolled up as in the deposit here in this number. So we have technology surcharge. We have general plan update surcharge, which is about 37,000. I have
So we
those
have-
numbers.
And then what's the 700 that of these deposits that are being forfeited that will,
Yeah, that's
Well,
one.
That's a
that-
building. That'll come to revenue this year.
that'll come into revenue? 'Cause
Yeah, this year.
We did this, we did this outreach, there were all these deposits that were
Yeah.
not collected by the developers. So we went and we sent them letters and said, come get it,
Yeah,
and they didn't.
yeah.
And so,
And the reason
well,
why
that seems like a
So-
long time ago we
Is
did
that-
Well, no,
I
because
thought that
the-
was supposed to be done by now. That's
it
not-
is, and we've
That's
talked to
what-
the auditor. We told him we were already mid audit, and we told him that we were gonna take them into revenue in this fiscal year, the 14-15 fiscal year. So we're gonna do that.
That was
Okay.
a long time
it
ago.
was a
Well-
long time ago.
So,
It
so,
was,
and that's roughly 400,000 we're gonna get?
no,
in-
7,
About 700.
$700,000
7.
Yeah.
in money that people didn't come pick up.
Well, and it's because a lot of the building department, the building fees, you have to understand the component and what it entails. It's the demolition fees that we charge them for recycling.
Right.
Now, we
And if they don't
have,
bring back their little
they don't bring
recycling
back their
tickets,
tags,
they don't
they don't
get
get
their
their money.
$5,000 back.
Yeah.
Yeah.
And you have to understand the way it works for these builders, these developers, these, a $5,000 deposit and keeping track of all those tickets for what, a year or 2 years worth of building, bringing them back, 2
They
years
just throw it
later,
to the-
to them it doesn't matter.
What, the
So if they
owner pays
repurposed
for it.
it, if they if they moved a swimming pool and filled in the other swimming pool, or whatever it is they did,
I
like
think it's-
spread the dirt.
I think it's going to the dump and
They're not keeping the
disposing
tags.
it.
Right,
They're
Right.
disposing of bad stuff.
instead of taking the concrete, separating the concrete from the and taking it down
Yeah.
to this and I got every deposit back.
Right.
I'm telling you.
Right.
I did.
That's a huge time expense for them, so maybe it's
Yeah.
not
We did
worth
it, yeah.
Yeah.
Yeah, it was
Yeah.
all, we had a third party do it, right? It was, what was the name of that company?
I was
Yeah.
supporting this grant of money.
So sometime between now and June
Yeah.
30th,
We'll see it.
we're gonna have a one-time revenue.
Yeah.
People live in the town anymore.
And you'll probably see it next year when we go over this. The other revenue will see a big increase, and Mayor DeGoya will say that's because of the planning department. building deposits.
George will take credit, Rick will take credit. We know who's gonna take credit.
So yeah, those deposits payable,
I
the,
might take credit.
I've never invited to.
We'll spend it.
I've got it spent.
yeah. So no,
Like that.
yeah, so we try to keep them current, but majority of that 1.3 million deposits is the building portion. So we also have planning deposits, park deposits, public work deposits. We have the security deposit from the play school. What was mentioned earlier, we have this technology surcharge for planning, building, and Department of Public Works. We have a surcharge for general plan update, and then we have a stormwater deposit that we have to charge to doing the stormwater analysis on new buildings that were required. So that's what that entails, but that 1.3 million, the majority of it is the building portion.
On page 25, is ERAF monies under other taxes?
No, it's under the property taxes.
It is
Yes.
under property taxes?
Yes, sir. Mm-hmm.
So, that's a lot of other taxes.
Other taxes is
Well,
our
it's
franchise
gonna be
fees.
Franchise taxes.
So we have franchise fees, we have water,
It's not, you have.
we have cable, we have PG&E, garbage, and then another big component that falls under that is the document transfer tax. And that's right, that this year was 483,000. So in this other taxes, 483,000 was document transfer tax. The remaining amount of that is broken out between PG&E franchise fee tax that we have, Cal Water franchise fee tax, and then the garbage and cable.
Wait, none of the other taxes is the parcel tax?
No, parcel
That's
tax is in
special.
in its own fund.
Yeah, it's his own, yeah.
So of the property taxes, that 7.3 million is ERAF, secured, unsecured, motor vehicle license fees, all that falls under the property tax component. Yeah. Mm-hmm.
So the,
Yeah. So other taxes, just when you think of that, just think of franchise fees and document transfer tax. That's what makes up the other tax. Other taxes. And then the permanent license fees, that's just the building business licenses.
And further down that page, under non-departmental, that's where the OPEB, $2 million.
Yes, sir.
what page?
So if you take that on page 25, so if you take that, you see how, and you could tell if you look at the budget amount. Original budget amount was 454,221, and then the final budget we did an amendment. It was 2,466,000. Well, because we added the 2 million component to that, and then the actual was 2.4 million.
That's non-departmental.
Yeah. So this page 25 is just the statement of revenue for the general fund, and you can see budget compared to actual, and so we were over in revenues by 660,000, and we were under in general government by 170,000 compared to budget, and total expenditures we were below to budget 965,000.
I think that's worth talking about.
Yeah, I mean, I think we.
Well, if you raise the budget high enough, you can always end up under it.
Well, we try not to, and I think.
I mean, the police, we adjusted the police budget up to $5.6 million, and we're gonna pat ourselves in the back because we didn't spend it all.
Right. Well, and I'm glad you brought that up, because of that 5.6 million that we budget for PD. Well, a big component of that is salaries, and salaries and wages. Well, we were understaffed, so there's some parts within that budget that we didn't meet our full salary budget because we didn't have we budgeted we budgeted a certain staffing level. Well, PD hasn't been at that staffing level. We've been down like 4 positions. You know, all across the
more
board.
than made up for that in overtime. Apparently, we didn't this year.
Well, it kind of it offsets in a sense, but and one it's
We had
not
6 people for last year,
right, and then we've had people out
That's what's gonna offset from the overtime.
for injuries. So whatever we lack in the salary, some of it gets made back up because of overtime, because we need coverage.
Well, and there weren't a lot of political events, you know, where we this last year,
Mhm.
I mean, right?
Yeah.
Because it wasn't an election year, like in, yeah.
Yeah.
that it needed a lot
Yeah.
more police.
But I think as a whole for departments, I mean, we have our budget, and the way we budget, we don't pad our budget. When we do our budget, this is what our costs are. This is what we anticipate what increases will be, whether or not for the operation side, and we budget accordingly. Coming with under budget, I think that's a great thing to have, and we've been doing well in maintaining our operations. Sometimes it's at the detriment that we don't have enough staffing, but we're mindful of it, and so we're not going over budget. We haven't been the last couple of years.
So I made a note just to our earlier conversation. If you look at page 27, the library fund had a change in fund balance of $1,000,002.
Yeah.
Yes.
It's
Yeah.
crazy. It's absolutely crazy.
Well, and the reason why it did, because we brought in the property taxes, but we only had 106,000 in expenditures. I mean, that's why we're budgeting these things, but what we budgeted was 273,600. We only spent 106,000. The revenues coming in, the property taxes coming in, so we didn't spend that. So that remaining balance goes into the bottom line. So
Yeah,
at the end of the fiscal year, library has an 8.5 fund balance. 8.5 million fund balance.
Inclusive of what's held at the county.
Wait,
Right.
Let me understand that. So the library maintenance, that's
That's our component.
our facilities expense
Right.
and gardening and outdoor management. It's not, all
Library
salaries and
No.
everything internal to the library comes out before we see the number.
Exactly. Correct.
So the tax revenue number that we're seeing there for the library, the 1.357 million, is not all of the revenue, it's the excess
That's the donor
above
fund.
the
Right.
library expenses. That's what
Comes
is
back to
called
us.
this year's donor fund
Mm-hmm.
supplement. And the expense is just what we're paying to our staff or MC or somebody to do the maintenance on the building.
I apologize, Chair.
That
I have
should
a
go up.
3:30 meeting I've gotta go to, but I think Robert's done an excellent job in the game of stuff the finance director. I think he's answered every-
He's doing very
every
well.
question.
I still think there's some funny math. He's doing very well.
Thank you.
Get that all in our head.
I'm sorry.
That's not fair. Really.
I apologize. Well, I do this for a living.
I still could not get my arms around why we let the county have $8,000,000 for a library when controlled. I just don't know why that happened.
Well, we
Yeah.
control.
It's been explained to me.
No,
No,
we
we
control
don't
the
have-
8
like,
million,
we have
we're
most of it.
controlling the
They're
8
taking
million.
it now.
No, yeah.
But a few years ago, they decided, they kind of woke up one morning and said, I think we're gonna keep that
Right.
excess donor funds, and the JPA board voted to do that.
It was a
Yeah.
JP.
And there's only 3 cities that have excess donor funds: Woodside, Portola Valley, and Atherton. Portola Valley had just depleted all of theirs because they had built their new thing. Woodside's about to deplete all of theirs. They've got a
Over the
couple
next
million
year.
over the next year because they're going to do a
They're
big
shutting the library down in Woodside.
Yeah.
And they're rebuilding it.
rebuilding. So
Yeah, but Portola
Once you
Valley-
said JPA, I got it.
you understand that?
Yeah.
Portola Valley's library. That's why I asked, the definition of what is a library.
That's the right question.
Because it's not being used as a library in total. It
No,
has
no, it's
multiple.
All libraries are reinventing themselves to be
Yeah.
community
So-
centers.
When we look at everything that we want to do or would like to do or what's on the wish list, why not?
No,
Utilize
believe
it
me.
in that way.
We're way down the path on discussing putting in a
Yeah.
fiber network throughout the whole town
Anyway.
and have and have it be part of
Because we
the
because
21st
we can't
century
do
library.
anything about the percentage.
Because Robert needs a new office. He could
Right.
get back
He needs
into the
to-
library.
That would work.
We're going to make
love that.
Robert the
Maybe
finance
bookshelf.
director of the library.
You can do that.
Supply room or whatever.
We're gonna have a study session the first Wednesday in April on exactly this topic because it's a
It's
big
big.
topic on the JPA.
Big.
and that it's being pushed to redistribute those funds.
Yeah.
So
Yeah.
Anybody have any further comment, questions on the auditor's report or the financial statements?
Gosh, you know, I thought we were making our finances simpler and more easily understood. This is very detailed, Robert.
It
And this is like the biggest report I've ever seen so far.
I'm sorry.
No.
Well, it's kind of, it's basically, we're following GAP, and, you know, all cities are uniform in how they present, as far as for GAP reporting purposes. But we try to, as we have as much footnotes as we can. We put footnotes to kind of explain numbers if you know, if you have questions and stuff. And again, if you ever have any questions, just feel free to, if you still have questions, you're looking through this, you know, jot them down, feel free out. I would be happy to meet with you all. We're trying to streamline it. We have the OpenGov transparency tool, so
Right.
that will be used more. And so those numbers are in here. It's just in here, it's very detailed because we have so many funds. We have the liabilities, the revenues, expenditures that are in here.
So, can I just ask him one more thing?
Yeah, ask him
Can
too.
you just briefly highlight the comments from the auditor? Oh, is that the next, that's
Oh,
our next.
the memorandum of
Yeah,
internal
the-
controls?
Yeah,
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 thank you for
because
bringing
there
that
were
up.
some, you know,
There was some in there.
areas where they had some issues about some of our procedures.
I thought it was pretty clean.
Yeah. Well, it came back. They did. They as far our auditors always look at our internal controls, and there was only 4 items, 3 of which we fixed. The first one was the compliance with the government code, with doing the treasurer's report. You know, they understand that we can only do our treasurer's report when we get all our statements from the bank. So they're just saying, making sure that the treasury report is presented to the council at least 1 month or the month right after. We mentioned to them we have only 1 meeting a month, so they're understanding of that. So they're just recommending that we make sure that we get the quarterly report to the council as soon as we can. So that was one that we fixed. Number 2 was the purchasing policy. We had updated with the making sure the credit cards. They were fine with that. That was a recommendation by them. We took the recommendation, we fixed it. The other one was the depreciation of assets. We only do the depreciation of assets in our system once a year. When we did it, there was a toggle in our system that wasn't checked, and so it did half a year of depreciation. We caught it at audit, and we ended up doing the second half of the depreciation. They just made it a finding as just making sure that we keep it, that we're aware of that whatever we need to do in the system, that it does a full year depreciation. The only other, so that was fine, they were okay with our process. The only thing that they did ask was the information system review, and this came up because they always look at this every year. In the past couple of years, we've been fine, but what's been happening with Target, with Home Depot, with all these, you know, everybody getting hacked.
Right.
They just want us to make it aware for us that to kind of put in measures and controls for our own financial system, making sure that no one can get in, making sure that when we walk away from our computers that after so many minutes our computer locks so no one can get in there. So those are measures that we'll work with our IT person. I did mention that to them, and I'm going to work with Mays and Associates every month or every other month. They can come into our system and do a data pool and see if there's any certain things of maybe ports that seem like could be an issue or item of concern. So those are the only things. So far, I mean, all the controls that they've had over the last couple of years, we've answered, we fixed.
So, you're pretty comfortable that we can't have happen here what happened at ABAG?
Yes, and the reason why, and I'm glad that you all brought that up. Yeah, I thought I brought it up. Yeah, there was an article
He says he's gonna.
in ABAG that there was an embezzlement. I guess it was a finance director,
20-year
administrative
finance
director. Yeah.
20 years.
Yeah.
20 years.
And somehow, and reading it, I think, and this person was with the ABAG's Finance Authority for Nonprofits. So ABAG has a nonprofit section within their organization. Reading it, I think it seemed like he created vendors
Mm-hmm.
and paid vendors. And we've gone over that with our auditor. We have a system of control, internal controls with our auditor. I review the check registers, the invoices. I sign off of them. They have to have a purchase order. When we send it to a vendor, we have to make sure they get their tax ID number, make sure they're legit. I look at invoices, department heads look at invoices, but when it gets paid, George and I are the system of balances.
Okay.
We both are authorized signers on the checks, but I look at the invoices, I sign them, he gets them, he reviews every AP batch that gets sent out. We send it to the council every council meeting. The council gets the check registers,
Right.
and the council's been diligent, and we've had questions, what is this, what is that?
Mm-hmm.
So those are in place
Okay.
for this type of things that can't happen, so this
Yeah.
won't happen.
Yeah.
And we do, we make sure that,
You brought up the credit card issue.
Yeah.
Which is why she brought up the audit, which is why you have these checks.
Yeah.
and
I met with.
Yeah. And then we met, George and I met with the chair and the vice chair earlier in September and discussed our controls in place that we have. And every year when we meet with the auditor, they come and they do an interview with us and make sure, okay, this what new has happened in your city, what new transactions, and they increase their test pool when they go to audit our purchases and stuff. So
Okay. Thank you.
It's amazing this stuff happens, so think mosquito abatement.
Yeah.
That woman who was inventing there.
Yeah.
She took time off getting paid by the district when you go to jail for her prior investment.
Yeah, well, you know what, I think it's sad that this is happening because it kind of puts a black eye on just the finance departments and stuff. But the other silver lining is it comes out and we're aware and we're like, okay, what can we do to make sure that this doesn't happen? So I'm looking into this ABAG issue. I'm trying to see what their financial policies and procedures are.
I'm kinda curious to see if there's anything further. I mean, if the guy's been here 20 years, did he start to do this last year?
Right.
Before?
Right.
Did he
That
start
they
to
just
do
didn't.
this 2 years ago?
Right, that they just didn't
Yeah.
catch it. Because, it sounds like, I don't know, that's fine, I don't wanna talk about it anymore.
No.
Thank you.
Oh, I'll
Okay,
use
so
one quick thing on this.
We have
You're
another
welcome.
agenda item here?
Yeah, is I just need a motion that,
I was gonna say,
Okay.
you need a motion, Rob.
yes.
Okay,
So, I guess I will entertain a motion
And
to
do we-
make a
We
recommendation.
accept the report and recommend to the council that they so approve it.
Yes. Second,
My second.
all in favor? Aye.
Cool. Yes, on this next item, I won't take much because this is an item that is just the beginning. This is gonna, I think, gonna be the next meeting that we have with the finance committee. We're gonna definitely go over this in detail. What you have before you is just what the CalPERS actuarial reports that came out this past fall, and these are actuarial reports as of June 30th, 2013. As you're aware, CalPERS is always a year behind in getting out their. Well, now it's 2 years, right? But what this is, I won't go into this whole report. It's just letting you know that the rate smoothing policy is happening in fiscal year 15-16. CalPERS is increasing the rates to capture their amortizing any unfunded liability within the next 30 years. They're amortizing that. So that's why they're gonna increase rates. They're gonna ramp it up in the first 5 years, and then to capture the unfunded liability quicker to pay it off. That's the reason for them doing this. So they'll ramp up for the first 5 years, starting 15-16, and then they'll smooth it out for the next 20 years, and then the last 5 years they'll smooth it back down on the rates. What this means is one, our normal costs right now are fixed costs, and this is on page 2 of the report. Our towards the bottom of our current 14-15 employer contribution rate for miscellaneous employees is 11.84%. That's the contribution rate that we pay CalPERS on behalf of miscellaneous employees, and it's payroll driven. So 11.84% of whatever that salary, that payroll was for that month, that biweekly, is what is contributed, the employer's contribution towards CalPERS retirement. So for 15-16, the new normal cost is 8.84%, plus they're amortizing the unfunded liability portion, which is another 8.05%. So our contribution rate for 15-16 will be 16.9% for miscellaneous employees. Right now it's 11.84%. So what they're trying to do now is they're trying to capture the unallocated, unfunded liability faster. So for us, that means 15-16, the unfunded liability is 120,606 for this for the unfunded liability for miscellaneous employees. So rather than what they're going to do is they're giving us the percentage of what that is. So that equates the 120,000 equates to 8.057%. So starting in 15-16, what they're going to do is they're going to invoice agencies whatever that portion is, instead of building it into the cost, and we would pay that. So that's for the miscellaneous employees. Currently, on the following page, the public safety employees, and you can see on the graph, the unfunded liability is 337,000 for 15-16. So currently the PD's rate is 29.556. Our member contribution rate for 14-15. In 15-16, that normal cost would be 20.23%. The amortized cost, the unfunded portion, is another 15.68%. So it's a total of 35.912%. So basically, if you want to say, we're going from 29.55% to 35.9%, basically, on member contribution rates. But we're only going to pay next year the 20.23% through payroll. The remaining 337 is that unfunded portion that they will invoice us for. So instead of us, what they could do is end up charging us 35.9% every payroll to capture that.
Wow.
What they want to do is, instead of doing that, our normal cost would be 20.23%, and then the unfunded portion will be 337,000. So the total, if you look for at 15-16 at 7.5% discount rate, it's a 460,000 unfunded liability that we have, that we would pay
So where is that?
based on the smoothing. If you go down to where it says
Yeah,
AV
got
versus MVA, it says based on the rate of 7.5%, this is approximately a payment of 460,000.
Where are you with that?
Oh, on the page 3 of the report.
Second paragraph
It's the
under
back side
AVA
of this.
versus MVA.
Yeah.
So, but what you're saying is the 460,000, is that that's the difference between the 29.556 and the
Well, no, that
No.
460 includes that 337,907 for PD
yeah,
and the 12606 for miscellaneous employees.
I see,
As
I
if-
see.
If we paid it up front.
Yeah.
So that's an
Say,
additional
then we'll have a
expense
rate of return.
Right.
that we would have next year over this year
Yes.
to the pension authority.
And
Yeah.
this is specific only to this town.
Right.
So
Correct.
we're doing this throughout the state, right?
Yes. Every agency that has a
This
CalPERS
is gonna have a devastating impact on some of these governments.
on these huge cities, of course. Yes.
It's gonna be unbelievable what they're gonna have to.
They were already doing smoothie, because we had a
Yeah.
normal cost, and we had
Right.
and it was treated just as a percentage of payroll.
Yes.
So the difference now is they're gonna give you $1 invoice for the
Right.
so-called smoothing portion. It
Yes.
really should be called catch-up.
Upcharge.
Correct.
Yeah,
Yes.
yeah.
They're
To
gonna give you,
pay.
but do you have to pay it? Because some people haven't been paying this, right? Some entities have not been.
A lot of them, if you saw the daily post
Right.
Yeah.
a month ago.
So what if they can't pay the bill?
Well, these entities, I think they'll work something out. Well, you have a whole year to pay this 460,000, right? So I think what they're in reading in this report, and it says that I think they'll charge a interest fee, like a late fee, if it's past so much, right? So
This is gonna grow,
Yeah.
grow.
it'll grow. Before in previous years, if you look at it, it was built into the rate already. But what they were finding is, they weren't amortizing the market value. So they realized, wait, we need to capture it quicker. And what they felt like doing is, well, in order to capture it quicker, in the short term, the rates are going to go up for employer contributions, but in the long term, they're going to stay flat and then go down. They won't go up as high.
But the long term is over
30
long-
years.
I mean, it's still
30
30
years, yeah.
years, so
Yeah.
we're all gonna be dead by then.
So they're amortizing for 30 years.
Speak for yourself.
but
I've already told my
Right.
children mom's gonna be here till she's 99.
there you go. Yeah. Yeah. But the good thing about it is on this report, on the reports coming forward, they give us discount rate sensitivity analysis. So I had provided like what it would look like if it was 6.5% instead of 7.5%, or if the discount rate was 8.5%, what it would look like. So CalPERS is going to come out with these going forward, every year. There's going to be a discount rate sensitivity, so you can see if it didn't come in what they projected it to be, how much of a difference it will be on our unfunded liability. And just for a referencing point, for the 13-14 fiscal year, CalPERS had a investment return of 18.3%.
Wow. That's what they say.
Yeah.
Really?
18.3%. It came in, and that's going to be used in the 15-16
That will
actual.
help
Right.
us a lot.
Right,
It
right.
will adjust.
Yeah, definitely.
Okay, because previously,
Not that much.
well,
Wait till you see it.
really?
Well, this is 460,000 more next year than
Yeah.
this year.
But they weren't, they didn't.
But this is
they
the-
didn't, yeah.
This is the 12-13 actuarial.
Right.
So they
So
made
they did not-
18.5%.
I know.
18.5% in 13-14, which we'll get next year,
Right.
and that'll be factored into the next year's actuarials.
Because 12-13, they were, what, at 3.5%?
No, I
Then-
think
No.
it was a
Were
little
they
bit higher. I think it was
7?
like 10%, 10 or 12%.
Was
Yeah,
it?
they were up
Yeah.
there. It was not. It
Yeah.
was.
They always
Oh.
claim they have.
Well, that's it,
Yeah.
but,
I don't know if it's actuality, but.
Yeah.
So what, just out of curiosity, what is the penalty for not paying?
I think it's just an interest rate. It's just what they used to do back in the day. If everybody used to have what they called, you didn't have to pay into the retirement. Some agencies
Pay as
would
you
know
go.
what it was, and they wouldn't pay into it till like maybe later in the year, and they realized, well, we don't have the money. They would charging. I think it's an interest. They charge interest for every month or something that it's not paid.
This number's
It's in the
huge
report.
for
I'll
cities.
find it and I'll send it to you all.
yeah, really,
It's just curious.
they're gonna look at our balance sheet and they're gonna say, oh no,
No, think about Daly City or South San Francisco.
That's-
These,
huge. They're gonna cut their staff, they're gonna cut their services.
Yeah,
I can see the state doing it, saying, okay, we're not, out of your share of the property tax, we're gonna take our pension money first before we give you anything for your city. That would be unfortunate.
Pardon me, Phil, if I have to leave, I have to go to my son's
That's fine.
soccer game.
Thank you, Mr. Lee. Appreciate it. We'll
The
be in
next
touch.
one's fine for me.
Yeah.
Oh, we're in, in March.
Okay.
too.
Yeah, we'll review it again. Okay. Thank you.
Is
Appreciate
is it possible for them
Yeah, yeah.
No, we're gonna lock you.
Thank you.
proceedings? Thank you. See you
Uh-huh.
next time.
So I know this. We'll go into this in detail again, but I just want to kind of give a brief summary of what this entails. So you
So
have
we can
both.
study up on it a
Right.
little bit.
You have both actuarial reports. You have a staff report explaining what's been happening in the last couple of years, what we've done within our own finance committee and within the council, kind of bring up to speed, and then what the CalPERS is doing. But we'll definitely tackle this at our next finance committee meeting.
We're just paying out the 700,000 that we're just gonna get.
That's right.
So
I mean,
with
to
the-
the extent that we can keep paying this
Right.
down,
Yeah.
then, those unfunded,
Yeah.
Down is at some point, everybody else is gonna go broke, and they're just gonna take, not only take our money, and do what we get.
No,
No,
it's only for our plan.
yeah, they can't,
I was thinking
But-
statewide.
right, yeah. I think paying it down is, the actuarial takes into account if all these people, stay the maximum time with
Yeah.
us and retire at the same time, you know, then we owe all this money. And George was talking to me about, the number of, employees that, we have that are less than 4 years
Right.
old,
Yeah, it's
right?
huge.
Yeah.
The majority of our town employees
The
are less than
demographics
4 years
changed.
old. I think there's only one that is 20.
Yeah.
I'm not thinking, I'm thinking in a macro sense and not micro sense. This time, I think we're fine. We're
I'm
doing
only
great.
concerned about this town.
Yeah.
Yeah, we've done a great job.
Yeah.
Yeah,
And
So-
that's one of the items to consider, but just like we did with OPEB, it's like, okay, how much do we wanna tackle this unfunded portion? Do we wanna put money aside, and then pay it down all at once, or pay as you go?
yeah.
So there's some items to consider, as we go forward, as we go into this next fiscal year and
Good.
understanding, so.
Okay.
Other than that,
Is that's the main, will be our main discussion
in March,
in March?
yeah.
And everybody's okay with March 10th?
I threw that out there, I mean,
So I can't see that far.
I won't be here.
okay.
I'll be gone.
How about
I'll wave your flag.
I just
Here
put
when
March
then.
10th, we can do,
You're not
Um,
coming back soon enough.
we can do later in March, but I wanna kinda get
When are you
another
gonna be
meeting.
back?
The 18th, I'm in time for the council meeting on the 18th. You guys can go ahead.
Okay, I can't do it earlier, I could do it later, and I can do it, I set that week aside, cause that's when we would normally do it.
Yeah,
I think that's fine.
Good.
okay,
Okay.
okay, and then move to adjourn,
So moved and seconded, all in favor, aye.
alright,
They're
thank you.